Kia ora and morena. Tēnā koutou katoa. Thank you everyone for joining us on today's Betashares webinar titled Better Building Blocks, a Smart Approach to Portfolio Construction. I should just highlight a few points. This webinar is for financial advisors and institutional investors only, and the materials are not to be distributed to retail investors. All information, those that wish to invest, I direct you to the Betashares website, which is betashares.co.nz, which does have the PDS and other fund information. Before we start also, this recording will be sent to everybody that's attended and those that registered at the end of today. Please feel free to ask any questions in the dialog box that you see on the screen there. In terms of information, so apart from sending you this webinar, on our website and on our New Zealand website, there is quite a lot of information. Please feel free to sign up for our regular publications and newsletters also. And you can follow the links to all of our social media outlets too. Thank you everyone again for joining. My name is Vinnie Wadhera. I'm an Executive Director in the Betashares business, and I head up our client service and account management for financial advisors and institutional investors across Australia and New Zealand. I'm joined by two of my colleagues, Cameron Gleeson on your left, who is a Senior Investment Strategist at Betashares. Welcome, Cameron. I'm also joined by David Bassanese, our Chief Economist, in the room next to us. Both Cameron and David have been to New Zealand numerous times and will so in the future. So today's webinar, I'm going to cover just a very brief Betashares introduction. I'm going to hand over to Cameron to cover the core part of the presentation, which is the building blocks for portfolio construction and their applicability to the Betashares PI funds. I'll then circle back and highlight some of the services and support that we offer financial advisors in New Zealand. I'll hand over to David then to cover our market and asset allocation views, followed by any Q&A. In terms of Betashares, Betashares is an Australian founded and Australasian focused fund manager. We were founded in 2009 and we have over 32 billion New Zealand dollars in assets. We have 5 New Zealand PI funds and we have 81 ASX listed ETFs and over 130 staff across Australia and New Zealand. One point of interest is that Rainmaker Research actually do some funds under management and inflow analysis in the Australian market. And in recent times, and they actually combine that across ETF managers and managed funds. And in recent times, Betashares has ranked #1 for net inflows in a trailing 12-month period. So we're quite proud of that and also humbled by it. We believe it's a testament to, well, testament in terms of the advisors that have actually spent the time and effort to review our strategies and select them for client portfolios. It's a testament to the innovative and very relevant investment exposures that we have as part of our product suite. It's also a testament to the very strong client service proposition that we've put in place for institutional investors and advisors, and also the values that we instill with our staff and that we hold ourselves accountable to with clients. Betashares has a long history of servicing advisors and institutional investors in New Zealand, and because many advisors have been accessing and using our Australian listed ETFs. But what became apparent was that advisors really did require some of our strategies in a much more tax efficient and effective PI fund structure. So we've recently gone down the path of launching a suite of PI funds, New Zealand-domiciled multi-rate PI funds for some of our flagship strategies. We took a different approach also. We applied for and have been granted a financial services license from the FMA, and we then have appointed local New Zealand service providers to support our funds. And here is our suite of PI funds that we've launched in New Zealand. They range from true to label core ethical funds. We have 2, a global and an Aussie fund, a global quality leaders fund, a low cost Australian equities fund, and an Australian corporate bond fund also. So there is some similar characteristics across this suite. They are all passive rules-based in nature. They are all low cost, particularly when you compare them to active managers. And they also have 4 of the 5 of them, at least, do fit into this category of a smart beta approach, or a better way of indexing. This is the real innovation that's occurred in indexing, and it seeks to either overcome some of the limitations or issues or drawbacks with traditional passive indices, or for us to put in place a set of rules to target a return premium or an outcome. But we'll run through these in a little bit more detail, and I'll hand over to Cameron to run through the better building blocks for portfolio construction.
Thank you, Vinnie, and kia ora to all on the line. So we talked a little bit about flows in the Australian industry and Betashares' share of flows. What we've seen predominantly in the last year and a half has been a shift in terms of the way people are looking at their portfolios, and a real focus on core portfolios. And as asset allocators, we're focusing on those 3 challenges: how to improve diversification, reduce costs, and obviously see strong, robust performance over the cycle. For a long period of time, people, when looking to use ETFs or other passive funds, have really thought about their choice as to the building blocks they use to build a portfolio as, do I want to use low cost, broad market passive, or do I want to use active? And in our view, we're not zealots for one case or another. We think there is a role for both low cost passive, but also exposures that give you something a little bit different. So today, I want to perhaps expand your thinking as to what passive investing can be, and show some case studies that really challenge the nature of how active managers apparently generate alpha, and talk to the benefits of using low cost broad market beta as well as smarter indexing solutions. Now, I mean, this is a great case study here. This is a global equity manager that has a growth style of investing, and they in fact won Fund Manager of the Year a couple of years ago. Very large fund, very successful, popular fund. They earned their place into a lot of client core portfolios. Now, on the chart, we show their performance in grey versus their benchmark, the MSCI World Index. And we can see that over the journey, there certainly has been periods of strong performance. But it's important not just to look at performance when looking at a fund and listen to their story, their narrative as to how they generate a unique return profile. Because when we actually look under the hood of that fund, we know that it's a very concentrated portfolio. It's about 20 stocks in that portfolio. They really are quite representative of the NASDAQ 100, the top part of the NASDAQ 100. And if we look at the performance, yes, it did look very strong to the end of 2021, but really reflected nothing more than what the NASDAQ, or our Betashares NDQ, Australian listed ETF, was providing on an after fee basis. Because this was a growth exposure in 2022, growth as a style of investing fell out of favor, and we start to see the concentration risk and the risk of this fund in terms of that pretty serious drawdown in 2022 and the volatility in this fund. Now, when I'm thinking about a growth style manager, and that might make sense to blend into my portfolio, I'm not necessarily saying you would disregard a manager such as this, but look for passive exposures, because they can offer lower costs and greater diversification than an active fund manager. There's also another really interesting element to the way that investors use active funds. And there's a lot of empirical research from behavioral finance into something called the performance behavior gap. The chart here on the left-hand side shows the since inception return of the fund manager. So this is what fund managers report as their returns. However, what investors derive out of actively managed funds, and indeed all funds, doesn't necessarily mirror that. And we see that the average investor's annual return in this particular fund is about 1.3% per annum, so below cash. And that's despite the fact that fund managers charge enormous outperformance fees. Now, if I compare that to the returns of our Australian listed NDQ or NASDAQ 100 ETF, we can see that the fund itself delivered over 18% per annum. And yes, the average fund investor has received slightly less than that. But that behavior gap that we tend to see between the fund outcomes and the investor outcomes is substantially less. And that's typical of an active versus passive performance gap. So it's not just about the performance of the active manager, but indeed how we tend to use actively managed funds, which are less transparent, and perhaps it's a more emotional journey if you can't have clarity as to what you're investing in. Now, thinking of things that I guess investment styles that I think are very important to include within a overall investing framework that move you outside broad market beta. I think quality as an investment style works for a number of reasons as a long-term holding, some of which are documented there. But like right now, if we look at, for example, the current earnings season, big focus on margins, on costs, cash flow, and debt servicing, quality companies stack up very well on these metrics, and I think they're very well placed in the current market environment. Now, the way that most investors will look to use quality is they'll default to using a quality active manager. And I show here 5 of essentially the leading quality managers available in Australia and New Zealand. These are global managers. They have an active management style. Their performance is in grey over a 5-year period, and the benchmark MSCI World is shown in blue. Now, yes, they're providing something different to the broad market exposure, not necessarily tracking that blue line. However, when we compare their performance to perhaps a quality benchmark, and I show here in orange our Betashares Global Quality Leaders ETF, for which we have a PI New Zealand version, we can see that their overall performance, in fact, is very much linked to or related to that performance of that quality benchmark. So they're not giving you broad market exposure, but they're giving you something which can be purchased far more cheaply, as you can see from the cost comparison, through a passive vehicle. And we also see advantages in terms of the stock concentration. Important to be diversified in terms of your stock-specific risk in a time of potential recession. Over the journey, we see that quality, or QLTY, the ASX code for this fund, has indeed outperformed all of these active managers. And that just speaks to the compounding of costs over a period of time, which tend to eat into active manager performance. So the Betashares Global Quality Leaders fund is available in a pie form. You can see there the sector makeup, the country makeup, and the top 10 names. As you'd expect, quality has been an outstanding type or style of exposure. You can see the performance of the underlying index over a long period of time, very strong outperformance. So it delivers something beyond broad market beta. Quality is a great factor to hold through the cycle. It's somewhat defensive in nature in terms of the way it drives its outperformance. But if we think about the way, for example, an active manager might try and deploy a quality investment style, they're likely to be filtering on the overall universe of 2,000 stocks first before doing stock-specific bets. So they're going to be looking at things like debt, equity, financial leverage, cash flow generation, earnings stability. These are all metrics that are used in the quality index, which the quality pie fund tracks. And so you're essentially exposing yourself to the same group of companies that are far lower cost load, and that results, when we look at long-term timeframes, in excellent outcomes at lower price point. The second fund I wanted to talk about briefly is our Australian investment grade corporate bond fund. And there's a couple of attributes that I think are really important to consider when looking at bonds, and particularly from the framing of a New Zealand investor. We see firstly the diversification across sectors. That's really critical. If we look at what's available in the New Zealand fixed income market, we know that there are a relatively narrow pool of issuers available in New Zealand. For example, the composite index, heavily dominated by government and financials as issuers. The size of the market is also materially smaller. And if we look at the Australian market, for example, the corporate credit market in Australia, over half the issuers are in fact non-Australian domiciled issuers. So the ability to access a more diversified pool of bonds through something like our Australian investment grade corporate bond fund, which accesses not just, for example, listed bonds, but also the over-the-counter market, a far broader pool, is really appealing. I think it's important to look at the opportunity though in terms of what compensation do you get. So I compare here the credit spreads of Australia in orange, the US in grey, and the New Zealand market in blue. And these are the credit spreads for bonds between 5 and 10 years to maturity. We can see that while these spreads used to be relatively similar in terms of the level of compensation you were getting for holding this credit, there is a particularly strong divergence that we've seen lately. And the uplift that you're getting from Australian investment grade credit is pretty compelling, particularly compared to New Zealand domestic credit. So, with the obviously the strong cash rates in New Zealand, the New Zealand hedged yield you can collect from holding Betashares Australian Investment Grade Corporate Bond Fund, very substantial. Is a great way to increase the income you're generating from your fixed income, while also diversifying across a pool of bonds that aren't necessarily available within the New Zealand fixed income market. And that's advantageous against passive exposures, but also doing this in a low cost, passive format, rules-based approach, more systematic, lower trading costs, lower fees over time. That really counts. That makes a difference. Vinnie.
Thank you, Cameron, for that overview on those two strategies, the global quality leaders and then the investment grade corporate bond fund. Just to round out our PI fund suite, I'll highlight the Betashares Australia 200 fund. This is essentially just the top 200 companies by market cap. It tracks the Sol Active Australia 200 index. However, the key advantages here is the cost. So management fee of 23 basis points. We've included a platform rebate. So the net fee there to investors is 18 basis points. So very low cost. Again, the bar for active managers has just got a whole lot higher with such low cost index portfolios. I'll actually just move on now to our ESG suite. And it's one that we're very proud of at Betashares. It's one that has also been very strongly adopted by advisors and institutional investors across Australia and New Zealand. And you can see the breadth of investment strategies that we have at Betashares. They range from impact products, they range from core ethical products, including our flagship EFI and FAIR, which are our ETFs for global and Australian equities, and then more sustainability themes. We have over it's actually $4.5 billion of assets across this ethical responsible investing suite, and we've been well recognised in terms of awards and ratings by a number of organisations. So with our flagship fund, or the PI funds that we've launched in New Zealand, the first one is the Betashares Global Sustainability Leaders Fund. It tracks the same index as the EFI ETF, however in a PI fund. The distinguishing features here is, and this fund, the ETF version of this has been in existence for over 7 years now on the ASX. We took a very different approach to sustainable, responsible investing all those years ago. We did not license an off-the-shelf index, and instead we put our own research and IP into formulating a rules-based approach. That allowed us to do a number of things, which have been now very well recognised by the market. That allowed us to include certain activities to screen out for that were very important to investors. Things like animal cruelty, supply chain concerns, and human rights. What it also allowed us to do was to screen beyond just very light screens in terms of industry categories. It allowed us to source data ourselves and to vet the data and to actually screen on revenues that companies generate too, which ensures that it is a true to label exposure. Again, I'm not going to run through the detailed process as Cameron didn't for the global quality and investment grade credit strategies. We're very happy to follow up in a meeting and go through a whole lot of process documentation and share with you the process inputs. But in the context of sharing a high level overview, this is it for the Global Sustainability Leaders Fund. So we do some very comprehensive screening in terms of identifying climate leaders from the available global stocks. We then apply some country liquidity screens and then the very diligent and comprehensive negative screens too. And you can see the activities that we screen out for, which makes this a very true to label exposure. And similarly is the case for, sorry, I should also just highlight again the performance here. Now performance is going to be a function of the actual portfolio that we hold in terms of the sectors, and of course there may be some divergence in terms of the broad market based on sectors that we don't hold. But again, this is a very true to label exposure. Similarly, the Australian Sustainability Leaders Fund, again, this is a very strongly adopted and widely supported fund across advisors and institutional investors via the ETF format, and it is already gaining some strong support as a PI fund. Again, we go through a very detailed screening process here, including the negative screens, and then also the identification of sustainability leaders, particularly in terms of renewable energy, which is incorporated in this strategy too. Again, we're happy to share with you over a meeting or via email the very detailed process and the process inputs for these. In terms, again, in terms of performance, you can see that it has quite robust performance when you compare it to the market benchmark. Another key feature, so again, just in summary, the advantages that these strategies have over traditional passive indices is the breadth of screens that we are screening for, the depth to which we screen for in terms of revenues and profitability, and I'll touch on engagement and proxy voting in a moment. And again, versus an active manager, we have a set of rules that are very transparent, so there's no judgment calls being made here on particular stocks. And of course, the management fee comes in much lower. In terms of reporting, we have put in place very comprehensive reporting. Your ESG-minded clients will want to see some more detailed reporting, and we've put that together. And that spans across carbon emission reporting on the portfolio, UN SDGs, and we've also got some very detailed reporting in terms of annual rebalances, the number of companies and the rationale why they either are removed out of the index or coming into the index. And lastly, at a corporate level, we take our responsibilities very seriously here. Firstly, we publish a very detailed stewardship report on an annual basis that covers a lot of our investment principles and philosophies, but also all of the engagement that we undertake. And on an ongoing basis, we also summarise our proxy voting too, which is quite considerable. So that rounds out all of the key features for our responsible investing suite, and including the 2 PI funds that we've launched. I'll now move to the Betashares Business Acceleration Services. And this incorporates, as we have already rolled out, a lot of these services and support in the New Zealand market. And it covers a few things, and I'll run through them very quickly. Firstly, it includes portfolio analytics and construction. We have a team here, an analytics desk, which Cameron is part of, where we're able to, if you're able to send us your current portfolio, we're able to model that up and also come back to you with some investment ideas, particularly in terms of some of the Betashares funds and how they may fit in the core part of your portfolio. And we're able to also do that reporting on that portfolio on an ongoing basis. Responsible investing, which I've already mentioned, in addition to the reporting that we do on the funds, we also are able to assist with very client-friendly fact finds also, which can form part of your advice plans, where you can sit down with a client and actually incorporate what some of their preferences are across a whole lot of different activities. So please let us know if that's of interest, and we're happy to share that with you. Practice development support is very important with Betashares. We launched this just last year, and already several leading advice firms have benefited from this in New Zealand. So what this encompasses is a few things. There's a few modules involved here. So we're here to assist you at a business level. And the first step of that is helping you create a short form business plan. So we'll go through a workbook and a workshop with you. Other members of your team can be part of this process too. And the end process is the end result of this process is a short form business plan. It's a similar process to help you formulate a client value proposition. So again, we'll go through a workbook. You'll have a chance to provide input, and you'll have an end document, which is your client value proposition. And lastly, a similar process to formulate your investment philosophy. It's not our investment philosophy, it's yours. We help you and guide you through a process to formulate that. The advisors that have actually formulated this have found it very useful in terms of putting it on their website or sharing it as part of client advice plans. So again, please reach out to us if that's of interest, and we're happy to go through the process with you. And the last one is our Capital Markets Insight. This is led by David Bassanese, our Chief Economist. He has already done several trips and webinars already for New Zealand advisors and institutional investors in terms of sharing what is happening in global markets and our views on asset allocation. So in that light, I'm now going to hand over to David in terms of our market and asset allocation views. David, over to you.
Thanks, Vinnie. Great to be with you all. Yeah, as Vinnie outlined, I'm the Chief Economist at Betashares, been here for about 8 years. Extensive experience in covering the macro economy, both at the Federal Treasury, OECD, Macquarie Bank, so I'm going to share with you, the current thinking from my perspective on the global markets. Also, I guess an outsider's perspective on New Zealand. But let me just press right ahead, and if you just start at the first slide. This is probably the single best summary measure of the health of the global economy. It's the composite index of covering manufacturing and services for the whole global economy. Europe, the United States, Japan, China, and you can see here when that index gets below 45, it's typically associated with a global recession. When it's in the range of 50 to 55, it's sort of what we call the Goldilocks sweet spot. Growth is not too strong, not too cold. And at the moment, you can see there was a risk that we were sliding into recession late last year on the back of very aggressive central bank interest rate cuts. But really, since late last year, there's been a bit of a rebound, and at the moment, it's sitting comfortably above 50. And the key takeaway here is through last year, we had all central banks around the world, aggressively raising rates to deal with high inflation. There was a fear that was going to cause a recession. I think many central banks probably assumed it would happen. We can touch on New Zealand in a minute, but the global economy has not tumbled into recession. The activity, particularly consumer spending, has remained remarkably resilient for a whole bunch of reasons. Savings that were built up during COVID, the fact that many businesses and households were able to lock in very low financing during the period of very low interest rates during COVID as well. Fiscal stimulus in the US has also been important. So that's point one. We are not in recession, and the economy has so far remained quite resilient to the rate rises. And the outlook, if interest rates don't have to rise a lot further, I would argue is pretty encouraging. Go to the next slide. You can see importantly, the resilience of global economic growth has not come at the cost of inflation staying higher, than we would like. So this is a chart of CPI inflation across the major developed economies, the US, Japan, and Europe. If you focus on the US for starters there in the blue line, you can see that inflation's come all the way down from just around 9% late last year on year, back down to 3%. So headline CPI inflation in the United States has fallen from 9% to 3%. And in fact, you could argue inflation has fallen just as fast as it rose over the past 6 to 12 months. Now, with a lag, we're seeing that also flow through into Europe and to some extent Japan. If you look at the lift in inflation, it did start in the US and it's fallen first in the US as well. So to an extent, the US is sort of leading the pack in terms of inflation trends. Now, this is very good news. We're seeing goods inflation basically go back to the pre-pandemic pattern of, if anything, small deflation in the goods sector. We're seeing housing services in the US also start to roll over. Rents were a big driver of housing inflation in the US over the past year, but we know rental markets are stabilising. Rents are no longer rising as strongly as they did during COVID, and with a lag that feeds through to the US inflation numbers. The last component of services, so you've got goods, you've got housing, and then you've got services ex-housing. And just focusing on the US, which is the most important economy in the world in terms of these trends, the prospects there are pretty good as well, because we're seeing the labour market, the excess demand for workers in the US ease as labour supply rebounds. More and more workers in the US are coming back into the labour force. Participation rate is picking up. And immigration to the US is also picking up. So to the extent there's been excess demand for workers, which has put upward pressure on wages. There's two ways to deal with that. You can slam the economy, you can raise interest rates and crush demand, or you can boost supply. And the good news is that supply has been doing some of the heavy lifting in recent months. So wages growth in the US is moderating, which I think with a lag will start to flow through to service sector inflation as well. So again, pretty encouraging news on the inflation front. Just go to the next slide. Now, not so good news to an extent is China. Of course, this is particularly relevant to Australia and New Zealand, as it's a major destination for our commodity exports. And just a range of charts there on the housing sector, and you can see that China has enjoyed a decade or so of booming conditions in construction, both infrastructure investment, high-rise apartment block construction. That has unwound. I mean, basically a bubble developed, particularly in high-rise apartment construction, and we're at a situation at the moment where activity there is pretty soft, and governments historically have basically responded to that by pump priming the economy, encouraging local governments or to state government, to banks to lend more to developers to encourage more building, encouraging local governments to sell more land. But the problem is that period of building has led to an excess supply. And the government at the moment is just debating, does it keep pump priming what is effectively a bubble in construction, or accept a slower pace of economic growth, but a more sustainable pace of growth? And at the moment, it looks as if China, is not going to stimulate its economy out of this problem. We're going to have to adjust to a period of weaker Chinese growth. Now, from a global economy perspective, it's not as bad as a US slowdown, because China doesn't actually import all that much as a share of its GDP from the rest of the world. But it is particularly relevant to Australia, and particularly in Australia, because of construction. We export iron ore to China, so if the construction sector remains weak, demand for steel and in turn demand for iron ore is going to soften. That's going to hurt iron ore. Now, what China is trying to do is encourage a rebalancing of activity toward consumer services and consumer consumption spending. Now, to the extent that happens, that may actually support the New Zealand market, to the extent that you do export a lot of food products, milk and the like. And so to the extent, there is a pivot toward consumer spending, it may not actually be, that bad for New Zealand, and that could provide an offset. But this is an ongoing issue in markets, that China growth is slowing down. But importantly, I don't think China's slowdown in and of itself is going to cause a major global downturn. That's more relevant. What is more relevant is what is going on in the United States. And so far, the outlook there remains pretty encouraging. Just go to the next slide. So what does all this mean for financial markets? Just on the top slide there, I've got the export price. This is the MSCI All Country World Index, so it's the global equity market. And you can see in 22 we had that bear market where the market sold off on the back of higher interest rates. Since late last year, markets have been rebounding in hopes that the global economy can avoid a soft landing. Can avoid a hard landing, and that inflation can come down without a recession. Now, the good news is, I think the evidence is accumulating that may well be the case. I guess the only issue for markets is that a lot of that good news has been priced in. If you look at the price to earnings ratio for global markets, it's ticked back up from just under 15 to up to around 16, 17 on the bottom left. But more importantly, if you look at the equity risk premium, so it's the earnings yield of the market. So the PE ratio inverted, you take away the bond yield, it's on the lower right chart there. You see the equity risk premium for the market has been declining. It's now down to around about 2%, which is the lowest level it's been since the GFC began, or the onset of the GFC back in the mid-2007. So the good news for markets is that hard landing looks like being averted. The less good news is that a lot of that has already been priced into the equity market. So that it is vulnerable, I would say, to at least a correction if we get an upside inflation surprise or a downside growth surprise, even if there are, be it short term. So the market is vulnerable to a correction. But I think from a broader point of view, I don't think we're going to revisit the lows that we saw late last year. I mean, the bear market, assuming no global recession, is over, and the rally that we've seen in markets since late last year, is the start of, I think, a new bull market. Just going through to the next slide. So from an equity point of view, I mean, I think it's there was relevant to be defensive when we thought there was a risk of a recession, but with inflation coming down, global growth remaining resilient, I think it's prudent to be at least, neutrally exposed to the equity market at the moment in terms of a tactical tilt relative to your strategic benchmark. On the bond front, I think it's even more interesting. This is a chart of US 10-year bond yields in dark, and the dotted line there is the 12-month forward expectation for that cash rate. And basically, you can see, broadly speaking, bond yields are peaking. I mean, there's been a little bit of a lift in the recent weeks for bond yields in the US, back over 4%. And that's essentially stemmed from the fact that the resilience of growth has meant that the markets have priced out the expectation of rate cuts as early as the first half of next year. They pushed that out, and as a result, bond yields have moved out and moved back out. But markets generally are not expecting further significant policy tightening in the US. There's a 50-50 chance of one more rate rise later this year, but the markets are pricing in then rate cuts from the second half of next year, which I think is, given the inflation outlook, not an unreasonable expectation. So broadly speaking, I think bond yields are sort of peaking here, and the next major move in yields will be down as growth slows, as inflation continues to come down, and central banks gradually start to talk about renormalizing rates to the downside, because at the moment they're still above their longer run average levels. So from an asset allocation point of view, I think bonds do look good value relative to, say, cash. So within the defensive part of the portfolio, I'd be advocating being overweight bonds versus cash. From a growth versus defensive portfolio, we have a more neutral position. So we're not overweight equities, but we're not underweight equities either at this point. If there is a correction due to valuation concerns, that might be an opportunity to go overweight equities on a pullback, but we're not wouldn't advocate being underweight waiting for that to happen, because again, we reserve being underweight when we think there's a serious chance of a global recession. Just moving to the next slide. Just quickly on Australia, look, as we're seeing globally, inflation is coming down. In the last few months, if anything, the inflation numbers have surprised on the downside in Australia. So the risk of us, at the same time, if we go to the next slide, consumer spending has been slowing. If we can just move to the next slide. Yeah, so just if you focus on the various measures of consumer spending there, so total consumer spending in the grey line there, you can see we've had as we've seen globally, very strong recovery in consumer spending following the lockdowns during COVID. But since late last year, consumer spending in Australia has slowed to a crawl under the weight of higher interest rates, reflecting the fact that a lot of the pent-up demand due to the lockdowns has been satiated. So we have had a slowdown in consumer spending. And so the combination of that plus inflation falling means, the RBA here probably doesn't need to do a lot more work either. So my base case is the Reserve Bank is done with raising interest rates. There is a meeting here in Australia today from the bank, widely expected to keep rates on hold. And I actually think the RBA will be looking to cut interest rates in the first half of next year, as again, growth slows, unemployment gradually moves a little bit higher, not a recession, but then start to renormalise rates in Australia. Finally, just on New Zealand, I mean, I guess New Zealand is one case where the central bank has gone harder in raising interest rates and has been more prepared to say, we think we need to drive the economy into a substantial slowdown, i.e. recession, to get inflation down. And you've had a particularly tight labour market, a lot of inflationary pressure, and so the Reserve Bank has gone harder. If you look at the forecasts for the RBNZ, they are expecting the unemployment rate to get back above 5%, to really bring down what is still, and I'm sure those on the ground over there would know, very tight labour market, very strong wages growth, and unfortunately there's no real solution to that problem but to raise rates and try to slow growth to less that you get a sort of wage price dynamic becoming entrenched into the economy. So New Zealand is going through a growth downturn at the moment. But inflation will, I think, then eventually come down on the back of that slowdown. And then, as in Australia and the United States, I think the RBNZ is also done in raising interest rates. It may take a little bit longer in cutting rates, but eventually, the next major move in rates in New Zealand will be to the downside as well. So, as is the case in Australia and the United States, I mean, I think the fixed income bond market outlook at the moment is certainly pretty attractive. That's pretty much it from me. I will leave it there, and I think we'll be opening it up to questions.
Thank you very much, David. Yes, so look, a lot of questions have actually come through. The first one I might actually put to you, David, and the question is, what do you see as the main risks of the soft landing scenario?
Yeah, good question. So I think there are upside and downside risks. I think the upside risk at the moment is the fact that just sneakily oil prices have started to move higher in the last few weeks. I mean, we thought oil prices were done and dusted, but they've ticked back over $80 a barrel. Saudi Arabia had cut production last year by 1 million barrels, unilaterally when oil prices were falling. With global growth rebounding, and Saudi, production still tight from OPEC, there is a risk that will feed through to headline inflation and may cause central banks to have to react to that. So that is certainly an upside inflation risk. The only thing I would say to that is I think if push comes to shove, Saudi Arabia can increase supply again. I don't think Saudi Arabia wants the oil price to derail the global recovery and cause a recession. So it doesn't want. So Saudi Arabia can manage oil prices effectively. It's now I guess the swing supplier to global markets. So if it need be, I think if oil prices did become a major risk, it would respond. Now on the downside is that activity in the US could slow by more than we currently expect. I'm watching the labour market in the US very closely. It is employment growth is slowing. So far, at least, a lot of the lead indicators like weekly jobless claims are still low. But it could be that the policy tightening that we've seen sneaks up on the economy and has an impact. But again, the Fed, if that were to happen, given inflation seems to be moving in the right direction, would just mean that they would cut interest rates somewhat earlier than would otherwise be the case. So watching that carefully, but I mean, if that does happen, it's particularly good news for the bond market. And I think the sort of growth scare wouldn't last that long because the Fed would be able to respond.
Sure. Thanks, David. Great answer to that one. Cameron, one for you that's come through is, where does the investment grade corporate bond fund fit into for a client portfolio?
Yes, so obviously any question around portfolio construction, you've got to take into account the circumstances of the investor. I guess there's a couple of general comments. If I look at New Zealand investors versus Australian investors, we see a much larger degree of participation in purchasing exchange-traded corporate credit in New Zealand than Australia, just a function of the markets there and how available corporate credit is. But we also do sort of see that the New Zealand fixed income market does have somewhat of a captive audience and isn't as large and isn't as diverse in terms of issuers. So, getting exposure to, for example, Australian investment grade corporate credit does tend to give you a premium in terms of the income you can generate, gives you much greater diversification. So I think as part of the overall mix of your bond portfolio, particularly when you're trying to add some high quality income or income uplift, it makes sense as part of your overall allocation. But happy to have a conversation with anyone on that specifics for a particular client trying to solve for.
Sure, fantastic. Another question is, look, how do we access the Betashares funds and also the practice development material? So I might take that. Look, the first part of that question is straightforward. In fact, we have a slide here prepared for that. So the 5 Betashares Pi funds are available on all the major platforms, and that's how they're accessible. For institutional investors, we are able to take direct applications, but please contact us for that. So you can see here the platform codes across the platforms. All 5 are on Adminis, Apex, Concilium, Wealth, and NZX Wealth Technology, and 2 of the funds are on One Answer. So that's the accessibility question. In terms of the practice development material, under our website, if you have a look under the advisor section, there's a practice development section, and that has actually all of the materials there across the business plan, the CVP, the investment documentation. But please reach out to us in regards to that, and we can run through the details. Look, on our website very clearly are the fees for all of the funds, and including the rebate margins, which will be on the platform PDSs, which gives the net MER, but please contact us for that. As a follow-up, we will be sending a copy of the slides and a recording of this webinar. We'd really appreciate your feedback in the dialogue box, so please fill that out. In any event, myself and Tom Powell will follow up with you. So we are your dedicated account managers, and you can see our email addresses there. We'll reach out to you just to maybe schedule just a very short 20-minute Zoom call where we can run through some of the funds in more detail and learn a little bit more about your investment process. Thank you all for joining us today. Really appreciate it.
Thank you.